welcome to this session. We'll be covering patterns in today's class, and the pattern of choice which I'll be covering is the bat pattern. Okay, it's one of the harmonic patterns. It's a very deep retracement pattern. Okay, now we've covered a few of the other patterns, the 786 retracement, the Gartley pattern, the Quasimodo head and shoulders pattern. Today we'll be covering the bat pattern. So before we get going, we just want to run through the disclaimer as always. Spread betting, Forex and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. Trading these products may not be suitable for everyone, so please ensure that you understand all the risks associated with trading. Information and comments provided here and under no circumstances are to be considered an offer or solicitation to invest, and all information provided is believed to be accurate to the date the information is produced. Nothing herein should be construed as investment advice, and information provided within the room is the personal opinion of the moderator and not Trader Mo. This content does not constitute financial, investment, or tax advice, and Trader Mo does not accept any liability for the content of or comments made during the session. So let's get on to our session, our class, and what I want to do, I'll bring up a fresh chart here. Okay, so what we'll be doing is, as I said, we'll be covering today's pattern, which is the bat. That's a deep retracement pattern. Now, what do I mean by a deep retracement pattern? Well, what we have is price obviously moving up. We'll do an example of a bullish pattern. Okay, so what we've covered so far in terms of the retracement patterns has been the basic up move. So if we just label this quickly as X and A. Okay, we've then had price retrace back on us, and when price starts to retrace, we've either looked at the simple 786 retracement as an entry point, which is right here. So you're looking to buy or enter as price comes into the 786 retracement, looking for price to continue up. Okay. The other pattern we covered, which was also a retracement pattern, was the Gartley pattern. Okay. So the Gartley pattern, we covered this. We're looking for a specific retracement to the 618. We're then looking for price start to move off this area, and the labeling for this point when we start to bounce would be A, B, then price starts to trace, and we would draw a fib from the A to B swing. Okay, and when price finds resistance at one of the levels and it starts to move down, you'll see we have a confluence area of the 786 with a 127 extension. Okay, so labeled, this would be point C up here, and we would look to enter at point D. Okay, so that would be classed or called a Gartley pattern. Okay, you see it comes down into the 786, which is a deep retracement nevertheless. Okay, it's much deeper than any of the others. Today's pattern is the bat pattern, discovered by Scott Carney, and it's very similar to the Gartley pattern in that it's a retracement pattern, except instead of retracing down to the 618 retracement for the first retracement, as was the Gartley pattern, you're looking for a retracement between the 38% and the 50%. Okay, so you'll see the retracement varies. So if you see price, it moves up the page, it then retraces 38, 50, and it stalls at one of these areas, either the 38, so it bounces from the 38, or around this area. It must at least hit a 38 retracement. Okay, so if it goes slightly through the 38 and then bounces, that's fine. If it hits the 50 and retraces, that's also fine. And if it sticks its nose through the 50 and also retraces, that's also fine. Okay, so you're kind of looking at this area here between the 38 and the 50, and as I said, if it comes down into that area, it can't touch the 618. Okay, so if it comes within a couple pips, then I would be looking more towards the Gartley pattern. Okay, so to keep it simple, between the 38 and 50, so if it's the 38 and retraces, or the 50 and retraces, we'll then draw a fib from this point. Okay, so if we labeled this, it would be A, as with the Gartley pattern. This would be point B, and we start to retrace. Okay, so let's just move that away for now, and we'll say it comes down to the 50, starts to retrace. And what you will notice is, with price coming down to the 50 area, it moves the extension from the AB swing. So what we have is, we have the 1618 extension of the AB swing and the 886 extension lining up. Okay, that forms our confluence zone. Remember, with the Gartley, the Fibonacci retracement was a 786 retracement with a 127 extension. With the BAT, it's 886 to 1618. Now, in terms of the way I draw the pattern, or look to draw the pattern, this is kind of how I would do it. I would draw a fib from A to B, looking at my fib extensions to come into that area. Okay, that's the way I do it. The other way, which you'll also see if you've kind of been looking at the pattern, or if you go on the internet, is drawing it from B to a retracement up here somewhere. Okay, so in drawing your Fibonacci retracement from A to B and looking for the extension, you would look at this swing here. Okay, and the deeper we kind of pull into this area, you'll notice these extensions start to change. So we've got these deeper retracements. It must have a minimum, in terms of the 886, it must have a minimum of a 1618 extension. So if you're drawing it from B, and we just label this as C, okay, if you're drawing it like that, you'll notice in this case we have the 886 with the 20 extension lined up here. Okay, sometimes you may have, you'll see the variables here, you may have a 2618 extension lining up with that. Other times you may have a 1618 in and around that vicinity as well. Okay, so I personally just draw it from A to B. So I draw it down like this, and I'm looking at the extensions around here. Okay, and I'm looking at the buy zone being here. So look at this 1618 area aligning with the 886, and in terms of the actual entry point, okay, look at the retracement. Okay, don't look at the extension, but focus on entering at the retracement. Okay, so keep it really straightforward. There's only one entry point, and that is the 886 level. Okay, pretty simple, I think. And this is classed as a deep retracement. Okay, obviously being the 886, it is the last in the line, besides taking out the 100% mark. Okay, so let's go and have a look at some examples of this. Alright, before we do that, sorry, let's just cover the pattern will look like, let's just mark this off quickly. The pattern will look like this, and you're looking for this leg down to complete at the 886 area. Okay, so pretty straightforward, I think. It's just the retracements that vary. So if you see price retrace 38 or 50%, then you're looking at a completion point at the 886 area as a bat. If price moves down to the 618 area, then you're looking at, in terms of the patterns, you're looking at the 786 area. Okay, so those are the difference in terms of the Gartley and the bat. Okay, so slightly different retracements, and on the initial swing before retracing up. So it's A, B, like this. So we got the Gartley here. So A, B, price retraces to C up here, and then completion zone is down here at the 886, which is point D. Okay, so pretty straightforward. And what you would look at in terms of, you looked at this in a textbook or something to that effect, the pattern would kind of be labeled or drawn like this. Okay, so you would have these triangles marked up. That's how you would see it. Okay, and all they've done is just connected these points in here. Okay, so that's the bullish pattern. So you'd be looking to buy, have a price to move up. All right, the bearish pattern, I'll just draw this over here so we can go back to that pattern in a second when it comes to trade entries, etc., or trade management. We have an initial move down, price then retraces. So once again, you're labeling, we have point X, we have point A, and once price starts to retrace from A, we draw a fib from the high down to the low, and once again, you're looking at the 38 to the 50. Okay, it can move slightly above the 50. It cannot hit the 61.8. Okay, so just keep that in mind. These patterns have got very specific rules to them. Now, when it starts to retrace, I'll draw, actually we'll label this first. So this would be point B once it starts to retrace. Okay, and we draw from A up to B. You'll see this variable in terms of the retracement, however, 1618 up there with the 886 level. So that's the completion zone. Price on the retracement here, forming the C point, it has to retrace at least 38%. Okay, once it traces at least 38%, then I'm looking for an up move to a completion point. So if we label this, we have C here, so it's X, A, B, C, and you're looking to trade the D point. Okay, that's the completion point. That's where we're looking to enter, and this is as a bearish pattern, so we're looking for a price to move down. Okay, and as before, if you have a textbook of this or a source on the internet, you'd simply be looking at something to this effect here. Okay, so we get the initial move down, as with the other retracement patterns, X to A, we label that. Price then rallies up to the minimum is 38%. It can retrace just past the 50%, but it cannot retrace to the 618. Okay, then price retraces off again, finds support at the 38 level before rallying. Now, one of the common things with this pattern is, let's get rid of these two legs here, is the CD leg. Okay, the move up from point C to point D, where you're looking to enter at. And I'll change the color. Let's change it to blue. So let's say we found we found all these points. We've got X, we've got A, we've got B, we've got C, and price starts to move up and it breaks above point B. Okay, when it breaks the highs at point B, then we can look at an entry around that 886 area. Okay, so we're anticipating the completion of point D. Now, this blue point, this line that I've marked in blue, so from the CD leg, this leg normally moves very aggressively. Okay, it normally it moves very quickly, and it will put off a lot of new traders. It will scare them out of the trade. Okay, because what you'll have is you'll have price kind of, the AB leg, normal price movement, BC gradual retrace, and all of a sudden the CD leg just flies up the page in this case of a bearish pattern. Okay, so just be wary of that, because that can put a lot of traders off. Okay, and the same if we just look at this pattern here. This is the bullish version. The CD leg is the leg that moves down with a lot of aggression. Okay, now how do we go about trading the pattern? Okay, now there's different ways of trading the pattern in terms of entry, stop loss, and take profits. Okay, in terms of entry levels or how to trade the pattern, once I've got point D marked on my chart, so I've got the area marked up, and that's where I'm kind of keen to look at doing business. What I will do is normally, most of the time, I will just put a limit order in at the 886 area. Okay, so it would kind of be something like this. My buy order would go to 886 level, and my stop loss would go below the low of point X. Okay, like that. And the take profits areas, different ways of going about it. What you will find, as I said before, with the CD leg moving very aggressively, it normally leaves a lot of space. Okay, space for price, if it does bounce, to move with great sort of ease, because you don't have a lot of chop around. You don't have a lot of consolidation in the CD leg normally. Okay, which means you can target this swing low right here at B quite easily. Okay, it normally stands out really nice and clear cut, and as I said, price can bounce from this area, move up with sort of decent momentum. Okay, you don't have to worry with having to chop through a lot of areas of resistance, etc. Okay, it doesn't always do that, but very, very often you'll find that CD leg really moves quite heavily. Okay, so the first option is trading with a limit order. Okay, first and foremost, limit order. The next option is waiting for price to sort of slow down, okay, to stall out. Right? So you're basically just watching price action on maybe a smaller time frame in this area. So if you identified the 886 and the 168 extension as a zone, okay, we'd reference that as a price reversal zone, and sometimes you'll see that on some of my charts I have a little box line up like that. So what I would simply be looking for is inside this area is for signs of rejection. Okay, as I said, more often than not, I will just simply use a limit order with a stop loss below point X. Okay, and if price continues down through here, that's also fine, because I know what my risk is. I don't have to sit there trying to time the market, and more often than not, you get a worse off fill anyway. So if I've got a limit order in, and I'm pretty confident in the area below price. And I haven't mentioned this in this pattern, but I will more or pretty much always only trade the pattern if I have this area below where the prices come off. So if I just change this to black, this area here, forget about all price here, okay, just for illustration, this area would be a key level of support. So I have a key level of support, a price moving down, it reacts, and then I'm looking for the bat, okay, the deep retracement into the 886 level for a long, okay. The opposite for the bearish pattern, where we have price move down, what I'd be looking for is resistance up here from a higher time frame, okay. So black line would represent daily or 4-hour level of resistance. Price would move up, hit resistance, reject, and then I would look for a retracement, okay. And once again, in terms of actual entry, so the 886 would be the sell zone, so limit order, stop loss above point X, okay, and take profits. Obviously a few ways of doing it. Point B here, point B normally stands up pretty nicely, so that could be one option there. So the space from entry point at D to B is normally pretty clear cut, okay, normally pretty clear cut, and you can look at entering or sort of taking profit there. The other option that you can look at to kind of keep it very straightforward and mechanical is once you have point D in place, okay, I would draw a fib from point A up to point D, alright, and what I would look at is simply targeting the 618 area, and when price moves up, or sorry, down in this case to the 38%, which is the first major Fibonacci retracement level, then I would look to get my stop loss up here to break even, okay. Then I have a free look at the trade, and either price bounces from the 38 level, takes me out of break even, or it continues down and I get paid. Okay, so pretty straightforward, I think. If you guys have questions on that, we're happy to go over it. So let's try and find some examples of this quickly. So we've got the theory part, pretty straightforward. Well, I think if it's not, let me know. So let's have a look at some patterns. All right, if we go to the 15-minute chart, I first want to try and find a decent pattern that kind of works, and then we can look at other patterns that fail, because they don't all work, unfortunately. But I'm just trying to start off with a decent example that we can look at. This one maybe. I'm not quite sure. I don't think we got there. This one's a little bit on the choppy side. It does work eventually, but let's see. Maybe up here. These are actually much easier than a Gartley. These are much easier in in real time. I know that may not seem the way, but here's a pattern here. Okay, not the prettiest, but we have a drop down. Okay, price rallies, so we get 38%, 50. We just push to the 50. Then we start to move down. So if we draw a fib from this swing low up to this swing high, price retraces. Okay, the rules are very straightforward. We cannot break below this low here. Okay, so if we label this, we have point X, we have down here point A. Okay, we have point B, price retraces down to point C. Now point C cannot break below, okay, this retracement of BC cannot break below point A, otherwise the pattern's invalid. Okay, so pretty straightforward. And then what we have is we're looking at this area here. See the 886 with a 1618 extension. Very, very nice, tight little conference. It's all within a pip. Okay, so we're looking for that area to sell short at, and it would be point D. Okay, so when price does this, moves up, obviously it sort of does its thing here, but have a look at the up move here. You see how price really shifts hard up into this area. Okay, this big swing here is pretty common for this pattern. It's aggressive price racing. It's pretty common, and it really puts a lot of traders off trying to get in on this. Okay, so as I said, you can wait for confirmation, but very often you'll miss the move. Okay, because it will come up, hit this area, and it will fade or sell off very, very quickly. Okay, very quickly, and you kind of sit there scratching your head and you kind of wonder what happened. So for me personally, I'll have the risk just above. So if I'm looking at trading this, enter on a limit order at the 886 area here. Okay, that would be my entry. Stop loss, we go above point X in this case because it's a sell, obviously. And in terms of taking profits, once I have this point that we've got some sort of rejection up here, then very simply I would draw a fib from point A up to point D. Okay, and when price moves down to the 38%, that's where I would get to break even. So you can see that move, it's like 23 pips. And the target would be very simply 618. Okay, in this case, the target isn't hit, and you would have been stopped to break even. Okay, that's the way it goes. Okay, so it's very, very simple in terms of the rules. And obviously the way I'm showing you trade it is pretty straightforward. Entry, stop loss, take profit. Okay, we've got all those three. Without those three things, you don't have a methodology. Okay, a lot of people will focus on the entry, but not the take profit. Right? If you don't have those three things, if you don't have an entry, a place to put your stop loss, and a place to take profits, you don't have a method. Okay, it's that simple, really. Now, there's obviously other target areas. If you want to start looking at other more discretionary ways, you'll see, like here we have B. You see this point? It stands out very clearly on the chart. Okay, and it's pretty common to see that you have this heavy move up, and you obviously have a lot of open space here. Okay, so you can target that area Pretty straightforward. So in this case, you're risking about 12 pips, target about 24 pips. Okay, so 2 to 1. Straightforward. Mechanical way, as I said, 618, pretty straightforward, right? And it gives you, I mean, in terms of the risk reward, you can see like 40 pips. So you're getting decent R on that. Okay, so that would be a bearish pattern. Let's have a look and see if we can find a bullish pattern for you guys. As I said, in terms of the pattern itself, it's far easier to kind of find the pattern when it's occurring. Okay, now what I'm doing here, I'm just really marking up the pattern and nothing more. Okay, I'm not looking at doing multiple time frame analysis, looking for key areas of support resistance. I'm just teaching you guys the pattern here. However, the important thing to note is, for my personal trading, if those things aren't happening at a decent area of support resistance, I'm just not going to be interested. Okay, so in this case, we get a nice move up from here to here. Okay, price retraces, in this case, to the 38%, and then it rallies. So once that happens, I can label this up. So we've got X, we've got A, we've got B, okay, so this is the swing down from A to B. Once I've got that and prices to retrace from B, I can draw my fibs from A down to B, okay, and price, because remember, for the bat pattern, it needs to come to at least a 38%, okay, 38 to the 50 zone. It then rallies, and this B up to, in this case, C, it cannot take out point A. If it breaks above, it's no go. Okay, then we look for something else. So it has very, very certain rules. Okay, very specific rules in terms of the structure. So this is point C up here, and in this case, you'll see with this 38%, the 886 and the 20 extension is where I'm looking to buy. Okay. Now, as I said, you could also draw your fibs from B to C. You see in this case, the 2 is kind of coming in just above that area. But, that's, sometimes you do it like that. I just personally draw from A down to B like that. Okay. So that would be the buy zone for me. That's point D, and that's where I'm looking to get long. Okay, so as price moves in, and once again, so this is the last leg, the CD leg. That's the last leg that we're keen on, right? Once again, have a look at this racing price action coming into the level. Okay, it's a very common occurrence to see this, right? Very common, and this will put a lot of traders off. Is you have price, nice up move here, retraces, gradual, bang, big move down. You start seeing a candle coming down, and you've got a limit in there. It can be a little bit on the scary side, okay, if you're not used to it. But that's where you want to make a trade, right there. The psychology is, completely against everything you're going against. You're going against every kind of natural tendency to want to be selling. That's where you want to buy, okay? The most difficult trade to make is the best trade to make. Okay, you've probably heard that somewhere. It's true. So that's the buy zone. Once again, when price starts to, it has some sort of retracement in there, we can draw a fib from point A, which is up here, down to point D, okay, to the low there, and so just make sure this is right. So from A down to D, first area of interest for me is this area here, right? 38%. At the 38%, sorry, let me just go back, step back 1 second. So entry is here at the 886 level, okay? Remember, when you buy, you want to add the spread, okay? Stop loss below point X, okay? Like such. And then the take profit, obviously a few ways of going about it. If you measure your fib from A down to the completion point, once price starts to retrace, very simply just target the 618, okay? And you can see in this case how the guys are actually using it to take profits there. See, it stores up, hang on the pip there, a little bit of consolidate, bang, okay? That's a very, very simple way of doing it. So break even when price gets up to 38%. We can move this to break even and we target the 618. So in that case, nice little trade, 67 pips or whatever the case is for, you know, initial risk somewhere down here for 25 pips, sorry. Okay. So that's the first option in terms of take profits. The other option is very simply, you see, with this big drop down, it gives a lot of space, okay? It gives you a lot of space with this big swing down because price doesn't have time to consolidate. So the next consolidation area is all the way up here. So that area there is a good place to take profit, and that's going to get you about 55, 56 pips around there, okay? So very straightforward. All right. If you're very aggressive, you can look at drawing a fib from A down to D, like we just did. Okay, so from A down to D, just slightly. And then very simply target the 127 extension. Or, if you're very, very aggressive, the 1618 extension. Okay. I know guys that do both, but you know, clearly the further price is moving to these areas, the less likelihood, you know, it's going to get there. It's got a long way to go. Okay, not everyone's happy with kind of letting these things ride out. I mean, this is over quite a while. So, you know, just find, you know, something that suits you. I personally like to kind of just target back just inside the range. And, you know, with the bat pattern, it's nice because it gives you, as I showed you, about 2.5 or somewhere around there, give or take. You know, and if you're targeting, obviously up here the extensions, and you know, you're looking at 150 pips for 20, 25 pip, you know. But it doesn't get hit very often, and obviously, you know, you've got to be happy with, you know, let's say price gets up here to the highs, and then it fades again. If you're not trading your stop or anything like that, there's tons of ways of doing it, really. Okay. Now let's have a look at the New Zealand dollar here, because it's a live market trade. But this one, we've had a rally. Price has dropped down to just past the 50, and then it's rallied up to the 618, and it's pulled back down, and it's hit the 886 area. Okay, so that's the completion point, and we've rallied up a little bit. You see, it hasn't quite got to the 38%, which was there. That was kind of the break-even point. It's taken another leg lower, spiking into this area here. Okay, so I'll just adjust that slightly. And with that, obviously now, here's your 38, take profits down slightly. So it's kind of messed up the numbers a little bit. But nevertheless, it's very straightforward, it's mechanical. Now, I didn't trade this as a bat, I just simply took it as a 786 retracement. So, I got a slightly better fall than a 786, but it's about 5 pips off. Okay, it's not a major in this case. Obviously, the larger the swing and the more volatile the pair, the larger 786, 886 distance is. Okay, in this case, 6 pips, it's not a big deal. This distance, depending, as I said, on the pair, the volatility, etc., it could be 20, 30, 40 pips. So you've got to take that into account. But in terms of the pattern that we've just taught, okay, very simple, very straightforward, and they work very well. Okay, so we get a push up, price then drops just past the 50, it then rallies up to the 618, and you see in this case, same thing, we have price moving down very aggressively. Okay, to even move deeper now. Very deep price action. Okay, now I don't know if this thing's going to hold or not. Okay, and that's why we have a stop loss in place. Okay, if it doesn't hold, it doesn't hold. We move on. Not a big deal. Okay, now in terms of take profits, as I mentioned, we've got 2 options, which I'll leave you guys with. The first is very simply from this swing. So if we label this, because we have labeled this now, let's just I'm just going to shift this up here. So let's just label this quickly. We've got point X. Okay. We rally up to point A. Price retraces down to point B. It then rallies back up to point C. Okay. And we're looking to trade it at point D, which is here. Okay. So we're looking to trade it at 886 as a bullish bat. Stop loss below the lows. Take profits either at point B because it's clear-cut resistance. Okay, that would give you around the 20. Let's say 22 pips with risk of around 14, somewhere around there. Okay. If you traded it for a take profit like this, then your take profit's going to be up at the 618, so about 33 pips. So obviously more profit, but price may not get there, and that's why we've got a break-even point here. Okay. So obviously, with the entry being 5 pips off, for me now, if I'm going to get to break even now, I'm cutting it pretty fine, to be honest. But, it doesn't matter. As I said, I'm just having a play about with the market today, just because of the bank holidays. Okay. So pretty straightforward, I think. Let's have a look at, see if we can find us another example here. It looks like there was one here, maybe. Yeah, here we go. So we have a rally, a nice push up. Price retraces to the minimum retracement, which is a 38%. Okay, so there we are. Let me just get rid of this red line. So we have a push up. then retrace. Once we get the retrace and price starts to come off this level, we can draw a fib from the high down to the low, okay? And price then rallies up like that, and we're looking at an entry at the 886. Now in this case, you'll see the extension, it doesn't quite line up as best, but nevertheless, I'm still watching that 886 area, okay? You'll probably get a better extension, maybe drawing it like this to this area here. And also, it doesn't really tell much, does it? But that's still a completion point. And once again, look how fast price moves down. Very big racing price action. And at one point, this candle right here, the one that you entered at one point, that was a very bearish candle. Okay, so it's literally reversed the whole move up in one candle. So that's why I say, for me, trading a limit order, what's going on there? Sorry, that wasn't meant to happen. For me, trading a limit order is my preferred method of entry. Okay, because of that, this fast racing in, fast racing out. Okay, and if it fails, on the plus side, it fails quickly, because if these things move very quickly, they literally just pop and take out the lows. Okay, the nice thing with these patterns is you don't have to wait around long to kind of find out what's happening normally. Okay, it's normally quick in and out. You either, at break even or profit taken, or your stop's popped and you move on. Okay, so if we look at this example once again, once we've got our entry, we're in the market. Obviously, stop loss starts down below this low here. Price reacts. We draw fibs from the very high down to the reaction low. Okay, depending on how you want to operate. 38% gets you to break even. Okay, and very simply, 618 is a target. And in this case, depending on your entry and your spread, you may very well have still been in this trade. Okay, it really would have depended upon your entry, and it's 2 pips, paying a pip spread, maybe. I mean, it's gone through the Asian session here. Spreads widening, coming into that area. You've paid the spread on the buy. It's let's put it that you'd have been lucky to have been paid on that. Okay, but worst case, break even. Okay, and these patterns will set up on any time frame, guys. Okay, as I said before, personally, I want to see what's going on the higher time frames. But check this out. From here, 5-minute chart. This one actually just didn't quite make it. I thought it made it quite nicely, but I thought we had a little retracement here. You see here, we've literally, you see our price. For me personally, I wouldn't touch this. See, it misses the 38%, even though it's missed it. It's only a pip or so on a 5-minute chart. It's then retraced and then moved up. You see, once again, it moves up very aggressively. Big bullish candles, bang, 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 bang. 886 stalls it, and then we fade. Okay, I wouldn't have taken that because it didn't hit the 38. Okay, so that's just my rules. You need to have some rules in place for these patterns. Okay, let's see if we can find another one here quickly. As I said, any time frame doesn't matter. The textbooks will teach this kind of stuff, just trading the pattern in isolation. Okay, and I'm not a big fan of that. I personally want to see these patterns completing at the right areas. Okay, and obviously, that's a little bit of discretion involved with that, but you've got to kind of develop your own method. This one, and this is an example of will be like two patterns on here, but if you look at this, the bat pattern, okay, it completes here, right down here at the 886 area. Very, very nice clear cut, okay, and 887. You may, if you had caught this trade, you would have a big smile on your face with the spread, okay. If not, you would have been rather upset, I'm sure. But this kind of thing happens in if you're trading orders, you get missed by like a pip or a fraction of a pip, and obviously it does this kind of thing. That happens. We also had, if you guys have looked at the other patterns, a Quasimodo pattern here. So we had this left shoulder coming through here, and this is also, and we'll cover this in another class, but this is what you reference or call a pattern within a pattern. Okay, so you actually have two patterns completing at the same or very close to the same area. So in this case, you have like a two pip completion point. So you'd have the bullish bat and the Quasimodo head and shoulders coming so close together. And when I'm in a situation like that, I will normally opt for the higher level, okay? Because I don't want to miss a trade. It's happened too many times. Okay. So, as I said, that's pretty much it in a nutshell. I thought we would have a little bit more time, but we kind of don't. So we're trying to find one more pattern here. This one, I don't think we quite made it. Maybe here. This is a 5-minute chart. That's a little bit iffy. But I think based on going to your homework, if you've got the theory now, and you can go and see kind of what, maybe this one, a 15-minute chart. It's always more difficult. Here's your area here. It's always more difficult to obviously go find the patterns after the fact when you're setting up and you've got a lot more time on your hands to watch the market. You can see these things a lot easier. But here's one more. Okay. Actually, no, I think that's the one we covered. I think that's the one we looked at. Funny enough. Never mind. See if we can find some others here. This one doesn't look. Yeah, it's more Gartley pattern. So just having a look at, you see that the difference. This is a Gartley pattern. The initial retracement comes down to the 618, and if you draw your fibs from the high down to the 618 to the low, you see the 786 and the 127 extension is the same. Okay, see that? So from here to here, here to here. Okay, so you see the completion points slightly different, right? And that is formed or gathered from the initial retracement. So if it stalls at 38 to 50, you want to think about a bat pattern, and if it stalls at 618, you want to think about a Gartley. Okay, and if you're not interested in either, you can just trade those 786 retracements. Okay, here's another bat here. You see a price drops. So when price rallies, and it hits the 38 or 50 and then it pulls back, you automatically just want to think about entering at the 886. Okay, that's pretty much it right there. Pretty straightforward. Okay, right guys, that's that. We'll wrap it there. I hope you find that helpful, and that hopefully be obviously too confusing. And we'll catch you guys next Tuesday. Have a good weekend if you're off. Cheers guys, thanks very much. Take it easy.